Welcome. My name is Chris Gosselin from Australian Fund Monitors. Today I'm talking to Simone Haslinger, the CEO of East Coast Capital Management, or ECCM. East Coast are involved in alternative markets. We're going to talk to Simone about the importance of alternative investments when creating a portfolio of managed funds. Simone, welcome.
Thanks, Chris.
Nice
for having
to have
me.
you here.
Thank you.
So first of all, give us a brief background of East Coast Capital Management and the main thrust of your strategy.
Sure thing. So at East Coast Capital Management, we are systematic trend followers, and we have a data-driven, disciplined process where we trade over 80 international futures markets across equities, bonds, currencies, and commodities. And we are one of the top-performing trend-following funds globally.
So 80 instruments, that gets pretty complex. How do you do that in practical terms?
Yeah, so look, it's a data-driven approach. So we have our algorithms that analyse the information, and we take a really dispassionate approach. So we're constantly monitoring those markets and also looking for new markets to invest in that are sufficiently liquid. And we're looking for the indicators that would suggest to us that those markets are starting to trend. And we get onto those trends. Risk management's inherent in what we do, so we will also put stop losses in place as soon as we enter into a trade. And we let our profits run and we cut our losses short.
So it's completely systematic, or is there any manual or people involvement in making decisions to say, yes, it's time to get in, or yes, it's time to get out?
We're entirely systematic, which is part of the beauty of the system. And we can talk a bit more about it, but we think behavioural biases are some of the pitfalls that investors come up against. And the beauty of this system is that we have a positive expectancy with no discretion.
So there's no cognitive bias in the process at all?
No, that's right. I mean, the main discretion that we have is which instruments do we put into our investable universe. And so when we approach that, we're really looking for highly liquid international markets that give us some complementary diversification and low correlation across our portfolio.
And when you say instruments, does that mean do you trade futures, or are you trading options, or is it just explain the instruments?
Yeah, so it's principally futures markets across the globe. In some cases we may trade an ETF instead of a futures contract, but it's almost entirely futures contracts.
So therefore completely liquid?
Entirely liquid.
Okay.
That's a bedstone of what we do.
Simone, you talk a lot to investors. What's the feedback from investors on what you're talking to them about?
Yeah, so I think there's a few things that investors really talk to us quite a bit about. First of all, I'd say that in Australia, most investors have pretty concentrated portfolios. So, very heavily skewed to Australian real estate, to equities and to bonds. And whilst that gives investors some degree of diversification, there have been periods in recent times where those correlations have broken down. So for example, in 2022, when equities and bonds both fell. And so I think a lot of investors are looking at the equity market today, which, is really priced for optimism, at multiple PE turns above long-term averages and a lot of geopolitical and economic risks on the horizon. And they're starting to question whether they have enough diversification in their portfolio. And from a diversification perspective, a lot of investors as well, to the extent that they do have alternatives in their portfolio, are tending to have things like private equity, venture capital, or maybe private credit in their portfolios. And when it comes down to it, they're often still highly correlated to those traditional portfolios of real estate, equities, or bonds. And so I think a lot of investors are really questioning whether their portfolios are going to give them sufficient insulation against potential shocks should markets shift. And then the last thing I'd say is there's also a bit of paralysis about what to do, because on the one hand, if you took a view that equities were too expensive and sold that position early, you'd be wishing you hadn't done that in recent months. And so not really knowing how to respond to those markets and not having a system to be able to handle that uncertainty is also a factor that's affecting investors at the moment.
Sure. So if you're taking that view, I'm concerned about equities, so I want to reduce my exposure to equities. What proportion should I have in either trend following or in alternatives?
Sure. So when we look at our results over more than 5.5 years now and compare that history against traditional portfolios in Australia, what we see is that you can actually put a very material proportion into trend following and increase your returns for a given amount of risk. So what we tend to say is, circa 20% allocation to something like trend following that's truly low correlation to traditional portfolios and proven to do so, that will start to show some good results in terms of your portfolio mix, in terms of Sharpe ratios and MAR ratios and so on. But of course, at the end of the day, it's a very individual decision as to your level of risk tolerance and what you're looking for in your portfolio.
Is 20% into one alternative strategy would traditionally seem high. Is that taking a risk by itself, or is the fact that you are diversified across these 80 different sectors or instruments sufficient to give you that buffer, that diversification buffer?
Yeah, look, of course, investors looking at trend following could consider different trend following managers as part of that allocation. I mean, certainly we're personally very heavily invested in our own strategies, so we're very comfortable that the strategy is designed to pivot dynamically to whatever is moving. And so if traditional assets aren't performing, we'll pivot to some other kind of market. But absolutely, investors should and do consider the level of allocations that they have with any particular manager and should be looking at all trend following funds and assessing them on their merits and their results.
So let's just look at some of the things that you do invest in. And obviously across 80 markets, you've got a broad range, including financials, presumably. So you can invest in equities and bonds,
yes,
indices.
Yeah, absolutely. Yeah, that's right. So we invest in international equity indices and short-term and bond instruments as well. And we do bring global diversification to the table. So we're not just invested in the ASX 200 and the Nasdaq and the S&P 500, but we invest in other geographies like the Nikkei or the Bursa Malaysia or European equity markets and so on. But I think what's interesting is because we recognise that investors have this heavy skew to traditional assets, we've really deliberately tried to incorporate as much diverse exposure as we can into our portfolio. And so roughly 40% of our investable universe is actually within the commodities space. And that's an area that most investors really don't have sufficient access to. So to give you some examples about the sorts of trades, obviously gold and silver have been strongly trending markets and a lot of people have talked about that. But one that I think people might find interesting that's much more niche is feeder cattle and live cattle. So most people probably aren't even aware that you can actually get exposure to a market like that. And even if you can, it's sort of how do you approach that market and assess it. The beauty of our system is we don't have to read rant reports and make weather predictions because we have a data-driven approach. But essentially what's happened for much of this year is that cattle prices have trended up beautifully. And what that's been driven by is drought, herd restocking and strong US beef demand. And so you've seen this demand-supply imbalance that has resulted in this beautiful upward trend. And it's a great example of the sort of uncorrelated return profile that we can get access to that most investors wouldn't be aware of or wouldn't have thought about to complement their portfolio.
So for most investors, feeder cattle, unless you're a farmer, would be obscure, to say the least. As you say, how would you even start to know what's happening in the market?
Exactly.
But I think the other thing, of course, is trends. You'd say this has been going up, but trends can also come down.
Absolutely. Can
your trend following system follow a trend down as successfully as it does going up?
Yes, absolutely. And, I think what we tend to talk about, I guess, is more the long trends because when we see them in practice, the data would suggest that often it's the long trends that outperform. And obviously we understand that systems are, global systems are kind of inflationary a lot of the time. But I think it is interesting to think about that in the context of overall correlations to portfolios, absolutely.
So talking about the dangers, risk, when does trend following not work? I presume when there's no trend.
Yes, that's right.
What do you, it seems a bit obvious, doesn't it? What do you do when there's no trend?
Yeah, so look, our systems will continue to look for trends, and what can happen, and I think the danger zone for trend following funds can be long periods where there's no clear direction as to where the market's going. The theory is that if we cast our net wide enough to capture as many markets as possible, something somewhere will be trending and yielding some kind of results. And what we hope for is that there's enough of those to offset whatever those small losses are that we continue to take as we think that maybe there's a trend emerging, but no, it hasn't emerged. What we've seen internationally is that trend following has just come through a bit of a drawdown, which was already started last year for many other funds. For us, it was really more on the back of Liberation Day, which clearly threw the world into a bit of chaos for a while. But what we know about trend following is that because these systems are positive expectancy, statistically over a long period of time, you tend to see that there's reasonable performance coming out of a drawdown period as new trends across the globe start to emerge. And so, hopefully we're coming into a period like that. We've been pleased to report up 6.6% last month.
Okay. So how do you avoid concentration, or is it purely you can invest in 80 different markets? And can you invest in them all at one time, or have you got concentration limits?
Yeah, so we don't have specific overlays like that per se. In theory, we could be invested in all 80 plus instruments at any point in time. The reality is that you're not, because not everything trends at once, or not everything will give you that kind of indicator that suggests a trend might be forming. What we do though is have this overlay where we think about the overall composition of our portfolio, our investable universe. And so we've deliberately skewed our portfolio a little lower towards equities than a traditional portfolio might be skewed. We obviously still have to include equities in our portfolio because there are great patches where equities trend, and we've obviously just seen part of that. But we are cognizant that we're a complement to most people's traditional portfolio, and so we want to make sure that we're giving our investors the greatest possible access to uncorrelated returns through the way that we've designed our portfolio of instruments.
And because you let your profits run, do you then get a situation where you're overly concentrated in a specific sector or a specific commodity?
Well, look, absolutely, we will let our profits run. And so, I suppose if it's only equities that are running at a particular point in time, we might be fully invested in equities across our portfolio. There's almost always other things that we're also invested in. So, we don't worry too much about that because it's actually part of the system design that we're really looking to capitalize on wherever the momentum is in markets at a point in time. And I guess the way that we think about it is dynamic asset allocation. So, if equities are in vogue, that's where we'll be. If equities fall out of favour, we'll position accordingly. And so, I think of it as trying to capture whatever the macro trends are across the world. Our positions will pivot based on what the markets are doing.
So, Simone, for an investor who's just starting out looking at trend following, where do they begin? Apart from, obviously, with East Coast Capital Management, but where's the starting point?
Yeah, so we would always encourage investors to do some research and look into it. What we enjoy is that we are part of an industry that's been operating since the 70s and 80s. And there is a wealth of academic research out there that has looked at trend following and why trend following continues to persist over many, many decades. There's actually academic research that looks back at data as far as they could find it, like in hundreds of years, looking at how trend following performs in all manner of different market regimes. And it demonstrates this ongoing persistence of what the research calls time series momentum as the factor that underpins trend following. So we encourage investors to do the research, look at that, look at how trend following has performed in periods where equity portfolios and traditional portfolios haven't performed. Have a look at 2008, have a look at 2022 and see how trend following portfolios performed in those sorts of environments and form your own judgment about whether this could be a good complement to a portfolio.
And do you provide that sort of information to investors or prospective investors via your website? Is there sort of an education element to it?
Yes, absolutely. So we have a lot of information about trend following on our website. And we also have videos on our YouTube channel, links through to particular sources of academic research that investors can have a look at as well. And we publish efficient frontier analysis in addition that investors can look at on our website.
From a fund monitor's point of view, we love the numbers. You know, we have this mantra that says, let the numbers do the talking. You know, it all sounds very plausible, but at the end of the day, it's all about risk and reward. What's the upside, what's the return, but also what's the risk.
Yes.
So this sounds quite logical to us as a sort of quant house and a numbers-based house.
Yeah.
But it'll stack up from the numbers point of view. Give us some of the examples. What's your performance since inception, and what sort of volatility is involved in that?
Sure. So our total return over the 5.5 years that we've been operating is up about 90% net of fees. That's about 12% from a CAGR perspective. From a risk return standpoint, we're talking volatility in the order of about 13% with that. And our worst drawdown is sitting at about 18%, which compares actually very favourably as compared to an ASX 200 portfolio over the same period of time.
That's pretty impressive stuff.
Thanks, Chris.
Okay. How does trend following compare with other alternative strategies when it comes to accessibility or diversification?
Sure. So trend following, because we invest in really liquid underlying markets, is a liquid product. We're a liquid alternative. And so a lot of those other alternatives that I mentioned earlier, private equity, venture capital, private credit, are often not particularly liquid, not particularly transparent as to the pricing, can be hard to access, can have lockups and fixed terms for investment as well. And so really, you know, we see ourselves as being quite uniquely placed in terms of not only the diversification that we can bring, being low correlated and genuinely low correlated with other products, but also in terms of the accessibility and the liquidity that we offer to investors.
Thanks, Simone. If you want to know more about this, you can go to East Coast Capital Management's website. You can also go to fundmonitors.com and have a look at the performance and analytics of ECCM, and you can invest directly online via Olivia 123. Simone, really nice to see you.
Great, thanks, Chris.
Thank you. That's it for today. We'll look forward to speaking to Simone again, maybe in a couple of months' time, to see what the state of trend is. Thank you.